a little bit, but we know that the central banks have been pumping them up. What do you make of this stock market? I mean, is this a real market? Is everything that's happening right now, can people count on it going up and up and up, or do you see something else happening?
Well, there isn't any real markets any longer, David, unfortunately. That was abrogated and annulled pretty much around the year 2008. It's been a progressive deterioration in markets, but central banks and governments have usurped all power from the free market, virtually all power that's left in the free market to decide what asset prices should be priced at. So we printed about $15 trillion worth of, I call it counterfeit confetti, since 2008. We're still doing $120, $130 billion worth of that same confetti each month. Mario Draghi said today that total will drop by 30 billion euros come January of 2018, but we'll stay at 30 billion euros all the way through till September, the end of September, and then we'll see what happens from there. And what happens when you buy, I mean, he's pretty much running out of bonds to buy, and the same thing over in Japan. The Bank of Japan under Mr. Kuroda is buying everything in sight. He has about 60% ownership in JGBs and ETFs, about the same in the entire ETF market. Over half of all Japanese ETFs are owned by the Bank of Japan. So they own most of the bonds, they own most of the stocks. So what price can you really say is free market driven anymore? None. So you asked if this can continue. It can continue as long as inflation doesn't spiral out of control, and asset bubbles will continue to grow and become further and further detached from reality, further and further detached from underlying economic growth. And that's the real hazard that lies ahead. I don't know when that bubble is going to burst. It could burst in late 2018. But when it does change, look out below.
Now you mentioned inflation. You also mentioned bubbles, but let's go with inflation first. Right now, the Fed is out there and they're reporting that they are seeing absolutely no inflation whatsoever, and they're trying to push inflation up. And there are other houses of the Fed that have done their calculation, and they say, inflation's like 3% or 3.1%. And the actual Fed, the head of the Fed, is saying, no, it's lower than that. Do you see inflation now in the country?
Well, of course there's inflation. So it's actually, I find very amusing, and I think your audience would find very amusing, that Janet Yellen, the head of the Federal Reserve, says we really don't understand inflation. Now, after printing about $3.5 trillion worth of credit and buying bonds from primary dealers, and all in the goal of achieving a 2% inflation target, she now admits that the Federal Reserve really doesn't understand inflation. Now, you have to ask yourself, Dave, what the hell is so important about a 2% inflation target? Why is that so crucial? As if you had an economy that had pretty low unemployment rates, and you had nominal GDP was at, say, 4%, and real GDP was 4%, so inflation was zero, that somehow that would be a problem to these people. And they would do everything they could to continue depreciating the purchasing power of the dollar until they got to 2%, regardless of the fact that everything else was nirvana. But they've taken control of the economy, all for the goal of keeping asset bubbles and inflation growing, and they don't understand why they're even doing it. Isn't that shocking and a bit disconcerting to people, that they're willing to go to such extremes to achieve inflation when they don't even understand how it gets there or how to really measure it, and base their whole entire ownership of the economy on that? That really bothers me, Dave. But they're going to continue printing until they reach 2% inflation. The same thing in the ECB, the same thing in the Bank of Japan. But you say, well, what's the inflation rate? Well, if you look at the CPI or the PCE, core inflation, they're running below 2%. but the core PCE is falling pretty quickly below 2%, down to 1.3%. And you say, well, Michael, you just said, printing money is inflationary. Well, where did all the inflation go? Well, I'll tell you. Thank you for asking me. Okay, housing prices are up over 6%. Average annual return over the past 5 years, over 6%, 6.1%. The stock bubble that you see is now 140% of GDP. Okay, so if you look back into the 70s, the 80s, and the 90s, it used to be about 50, 55, maybe 60% of the economy. Now we are 140%. So if you look at the market cap as a percentage of equities. This is insane. If you look at bubbles, look at the bond bubble, where you have $8 trillion worth of negative yielding sovereign debt, 1.6 trillion of negative yielding corporate debt. And then you go around saying, well, where's the inflation? Well, the inflation, the phony, cheap credit printed by fiat or decree went to the banking system around the world, and these banks decided to do what with it? In a debt-saturated world where there isn't really a demand to make loans from the public, what did they do with it? They purchased assets. And we have rampant, unprecedented, massive, humongous inflation in assets, stocks, real estate, and fixed income.
Now, you mentioned that the Fed, they don't understand inflation. They don't, get it. If inflation gets out of control, how are they going to control it then?
Well, they're gonna say, well, first of all, they're gonna cheer the fact that they reached 2%, as if they have any. So they don't know how inflation is engendered. Then they don't know how to measure it, but they still think they can stick the landing on 2% inflation. I mean, it's hysterical when you really think about it, Dave. So we're gonna go to 2%, and they're gonna throw out the party hats, and then it's gonna go to 3%, and then it's gonna go to 4%, and they're gonna panic. And they're going to have to jack up interest rates like crazy, very, very quickly. And when you jack up interest rates very quickly, but your debt outstanding has exploded due to the very same formula that you used to get inflation higher, so you took interest rates lower, you made borrowing money very, very cheap. What happens when governments see that they don't have to pay interest expense on debt because that the central bank owns that debt? What do? They go out and borrow more money. And when corporations get paid to borrow money, what do? They borrow money. And even the public, even though they're saturated in debt, they're at a record 14.2 trillion in debt. The public sector, household debt. So when rates rise dramatically on $230 trillion of global debt, an all-time record high, then the entire economy collapses. That's where we're headed. Now, I know, listen, I manage money for a living. So I'm not sitting here as a Cassandra saying, just own gold and short the stock market always. You have to know how to play the game, and I do. But what I am saying to you is don't believe the mainstream media. This is why I come on shows like yours. Because you give people like me who understand this is all artificial a platform to warn people. Hey, you don't have to go short the market now. You don't have to only own gold or stay in cash. You could play the game, but have a model in place to discern when it's time to exit before the music stops, and even try to profit from the third epic collapse in equity prices since the year 2000. That's what I do here at Pento Portfolio Strategies.
Now, you mentioned the interest rates moving up. Now, the Fed, they're talking about raising the interest rates. They haven't as of since the last time. It's been a couple of months now. They're also talking about unwinding their balance sheet. So is the ECB. I mean, is this all possible where they can unwind and get rid of all the toxic real estate, the bonds, and everything they have, and raise the rates at the same exact time?
It's a pipe dream. So first of all, if you look at the Bank of Japan, let's go through the Bank of Japan, ECB, and Fed. So the Bank of Japan doesn't even really bother talking much about reducing their $700 billion a year of counterfeiting. They can't even begin to discuss it because they're aware that a Japanese 10-year note which has been pegged at 0%, just right around zero, goose egg, nothing. You get nothing in interest if you own a JGB each and every year going out for 10 years. They know, they're fully aware that if they even mention the word tapering, that bond prices in Japan collapse, yields will soar because it's an insolvent nation, way above 2%, could go to 4% very, very quickly, and that would cause a collapse of the Japanese bubble economy and stock market. So they're not even talking about it over there, Mr. Abe and Mr. Kuroda. They don't even mention it. Now, Mr. Draghi isn't really even mentioning interest rate increases. He's just talking about tapering asset purchases. He's not talking about unwinding his balance sheet. That's not even in the over the horizon. They don't know when they're going to be able to do that. They're still printing $30 billion a month all the way through to the end of September 2018. So they're not even talking about raising rates or draining their balance sheet. They're rolling everything over and they're adding to that balance sheet. Then you talk about the Federal Reserve. Well, yes, they ended QE. They're the ones. The Federal Reserve is the one under Janet Yellen who is already selling $10 billion worth of MBS and treasuries per month. That'll grow to $50 billion by October. So, but here's where I'm going with this. So by the end of September 2018, you're going to have possibly the end of European QE. They go down to zero, or at least they'll announce that they'll be out by the end of the year. So you're going to go, by the end of 2018, you're going to see zero money printing from the ECB and 50 billion in sell orders from the Federal Reserve. That's when you could get a panic in the bond market, and that's what starts the whole thing to unravel. That's ahead. So what do you do between then and now? You don't hide under you don't hide under a blanket. You watch for the collapse in bond prices and the surge in yields. You have a model that predicts and prepares for that. But keep in mind that this is going to end very, very badly.
Now, we saw out in Puerto Rico, they're having this huge debt problem, and it looks like they're defaulting. Trump visited Puerto Rico, and he made this strange statement, and everyone who heard it went, whoa, wipe out the debt? Puerto Rico is going to have to do this. I mean, when he said this, central bankers, they don't like anyone wiping out any type of debt, and creditors, they don't like that either. Why do you think he went down there and actually said that?
Well, in cases of very small amounts of debt, like Cyprus and in Puerto Rico, it's easy to say, hey, the $70 billion that you owe, well, you're just going to screw Goldman Sachs. So, whoever owns this debt, it's not true. A lot of people own this debt other than Goldman Sachs. But you can wipe out 70 billion debt, Mr. Trump. But more importantly, and by the way, that's very deflationary. That's why I have an inflation-deflation portfolio here. That's very deflationary. But more importantly, what did he say about the $100+ trillion in Social Security, Medicare, and Medicaid unfunded liabilities and debt? He said that's not to be touched. So you're going to have, maybe when it's a small municipality, or maybe a very small pension plan, or a small territory, maybe you'll have a restructuring that's explicit. But more importantly, major defaults will not be restructured. They will be monetized away. They will be printed. So you're going to get your principal back in nominal terms, but in your purchasing power of that principal will be down many, many percentiles.
Now, we also mentioned bubbles in the market, and there are financial pundits out there calling the next bubble the everything bubble, where I guess that includes almost everything. When you look out there, Michael, I mean, do you see bubbles just everywhere you look?
Well, there's a bubble in commercial real estate. There's a bubble in residential real estate. There's a bubble in equities globally. There's a bubble in equities globally. The biggest bubble in the world is the bond bubble. But maybe even bigger than that is the bubble of faith that we have in central bankers to actually get this thing right. Even though they're winging it, Dave. They have no clue. They admit it. It's avowed They have no clue what causes inflation. They don't even know really. They don't have a cogent reason to explain to the public why they need inflation, much less 2% inflation. But they're on a kamikaze mission to blow up asset prices, to create bubbles everywhere, and to somehow convey to the public they can fix everything once they burst yet again. They tried that in the year 2000, and they had the NASDAQ bubble. Rates went to 1%. After the housing bubble, rates went to 0%, stayed there for eight or 9 years, virtual 0% interest rates. What's their next trick? Well, their next trick is going to be, they don't have the room. They don't have 525 basis points to fix things this time around, the next collapse, which is coming. They're going to go to helicopter money. That's the next trick. So an end run around the banking system and direct purchases from the public, from the central bank to the public. You talk about universal basic income. You talk about direct purchases of bonds, direct purchases of stocks, direct purchases of real estate, direct transfer payments that are directly funded by the central bank. Or they make direct purchases to the Treasury. They just wipe out the banking system and just print money and have it directly infused, no other conduit, directly infused into the economy. That's what's coming next. Oh, of course, and one more thing you have to mention is negative interest rates. So helicopter money and negative interest rates, that's what's probably coming next after this collapse.
So, will that actually help the economy at that point? When they start infusing and creating all this currency, how does that really help?
No, it's not going to help at all. They think it helps. Like I said, they think that the driver of economic growth, they think, is inflation. You have to ask yourself, it's not my opinion. Why do we need, I never heard Janet Yellen talk about a GDP target. There's no GDP target. There's an inflation target. Why? So no one has ever hammered her on this point. If I was asking her a question, I'd say, why do we have an inflation target? Why don't we have a GDP target? We're not targeting growth, we're targeting inflation. Well, you're going to get a lot of that, but it's not going to help. And all you have to look at is what happened in Weimar Germany, in Argentina, in Hungary, some of the massive inflation breakouts. Inflation is bad. It's just plain old bad. Having 0% inflation is good. Having a mild deflation is good. Having inflation at 2% is bad. And I don't believe inflation just goes to 2%. We have 1.3% on the core PCE. And as I just mentioned to you, that stock prices are at 140% of the economy. So, they don't know how to measure inflation. They don't know why they need inflation. The only reason they really, if you actually put some truth serum into Ms. Yellen and the FOMC members, I think what they're trying to do, when they won't tell you this, is they need to keep asset prices in a perpetual bubble so banks don't become insolvent. That's probably the dynamic in truth that's going on here. What would happen to a bank's balance sheet if real estate prices dropped 30% again? What would happen to all these financial institutions would be insolvent? What would happen to financial institutions if we had a protracted and deep bear market in equities? What would happen to the trillions of dollars that are parked in bonds on the bank's balance sheets if we had a bear market in bonds? Well, that's what they're really worried about. They're caught in this, catch-22, not X-22. They're caught in this catch-22 where they know that they have created this bubble and they can never get out. But the more they keep the bubble going, the more dangerous it becomes. It's very scary.
Now, if the Fed pushes out this universal basic income or the helicopter money, what happens to pensions and savings and your cash in the stock market? What happens to all of that?
Well, anybody that owns fixed income would be wiped out unless you own part of the fixed income that's part of the Fed's purchases. But even if you own a sovereign bond that's part of the Fed's purchases, your purchasing power for everything else gets destroyed. And the middle class, even though they've suffered so greatly under the past few decades, ever since really Nixon closed the gold window in 1971, the acceleration of the evisceration of the middle class will be profound. And that's when you have things like, things that we don't like to talk about socially. So that's unfortunately where we are. We had an opportunity, excuse me, David, we had an opportunity in 2008 to let the market work, to let the free market work. That's how you started this interview. The markets don't work anymore. I made that very clear. We had the opportunity to unwind asset bubbles, to allow interest rates to rise, which would cause people to pay down their debt, and we could have a normal, healthy economy after the other side of a hopefully truncated depression, maybe a year or two, or maybe even a protracted recession, but just to wipe out all of the imbalances. But they doubled and tripled down on the theory of borrow, print, and spend. So it's gotten to such a gargantuan position that they're trapped. They have nothing left to do but hope that these bubbles continue and that they don't grow to such a dangerous level. But we passed that Rubicon many, many, many miles ago.
And for my last question, Michael, when do you think the Fed will start losing control? When do you think things will start to really, break down where people actually take notice?
Well, my best guess is, no one knows the exact date, but I will tell you this, that as I mentioned earlier, in October of 2018, you're going to have a situation, most likely, where central bank purchases go from 130 billion per month to zero. So central banks will no longer be net buyers of assets. And you're going to have front runners coming in that want to sell these bonds, that want to sell these stocks ahead of what they see coming. So for instance, in October of 2018, if Mario Draghi and the ECB says bond purchases will go to zero in January, and then we'll start slowly raising rates. Well, how do you raise rates as a central bank? You sell assets. And then you'll have the Fed's balance sheet being unwound in 2019. I'm sorry, Fed's balance sheet will already be on the pace of 50 billion per month in October 2018. You'll have the ECB starting to unwind assets in 2019, and you might see the investing public in a panic to front run those offers to sell. They were front running bids the whole way up. So they were buying bonds and stocks ahead of the central banks. They'll be selling bonds and stocks and real estate ahead of the offers from central banks. And that should, I'm going to say, I can't guarantee it, but that sure as heck should send these asset prices tumbling. And that's on the back end of that. That's when you get your the re-engagement of central banks, which will be a panic to get back into helicopter money, and negative rates. So that's how I see this playing out. So you have about another year or so to play games. You have to do it very carefully though, with a professional.
Michael, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
So the website is pentoport.com. They could email me at mpento@pentoport.com. And the office number here is 732-772-9500.
Michael, once again, thank you very much for being on the X22 Report Spotlight. I really appreciate it.
Always a pleasure, Dave.
Thank you.